Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another review of Velocity Banking. And did you know that Velocity Banking is kind of the same thing and pretty much is not saving money? That's really all Velocity Banking is. And if you ask the average person if they need to save money, they say, "Oh man, it's such a good idea to have like 3 to 6 months of expenses for emergency fund." Folks, if you have a $6,000 income and $5,794 in expenses and only $200 of savings, it's gonna take you forever to save money for emergency fund. And instead of doing what other people do, which is saving money, we're not going to do that. That's what velocity banking is, and we're going to throw a line of credit in there in the mix to help us not save money. So, what is velocity banking? All it is a debt payoff strategy where you throw all your money into something called a line of credit. What's a line of credit? All it is a financial tool where you could borrow money, pay it back, and use it over and over again. So here it is, my ta-da home equity line of credit, first lien, paid off my mortgage, and then I got it $280,000. Wow. this is this is crazy. $280,000 line of credit. So basically I go to bank's website, click a button, and then they'll dump 280 or up to potentially $280,000 and charge me a 7.5 percent interest rate, right? So that's what we're going to do. And I'm going to go ahead and we're going to go and pay off the debt with $6,000 a month income. So that's about $100,000 a year after tax. And if you have two people making $50,000, then that's $6,000 a month income, right? I think maybe a little bit more. I don't know. You maybe got deductions and stuff, but we're gonna assume we have this income and then we have all this debt: two credit cards, two auto loans, a student loan, and a mortgage. And we're also gonna assume we have access to a $60,000 line of credit, right? And I know what some of you are thinking because I get this all the time. But when you tell me that $60,000 line of credit, like who's gonna give you that, right? Like I don't know what I'm talking about. I'm just gonna show you this because I have over $579,000 in lines of credit. I'll probably get more because you know what the secret of getting credit is? Banks don't lend money to people who need it, right? And if you understand that principle, then you'll be easily able to get credit. Okay, so let's go ahead and assume for now we're gonna have a line of credit for us available. And we're gonna move these credit cards here. So how much is that? 25, 26,000 in the balance. That's 51,000. So what we're gonna do is just do a balance transfer of $51,000. And guess what happens with this $51,000 balance transfer? Oh my goodness, these go to zero. And so if you look at the savings here, simply by not saving money and dumping all of our money into debt and maximizing our cash flow, we're going to easily pay off our debt, right? And so what's the final step? Paycheck into the line of credit, expenses out, and then rinse and repeat over and over again, right? And so we're going to go ahead and do this and take the next month's balance plus the previous month's. I'm sorry, to get the next month's balance is based on the previous month's balance, previous month's interest, minus whatever our cash flow number is, 1968.35. And then I am going to take the average of these two numbers, multiply it by the interest rate, and then divide by 12. Okay. And then I'm going to go ahead and copy and paste, right? Okay, let's go ahead and do that. And I am going to go to 29 right here. So 29 months, we paid off all our debt. Whoa, that's so simple. So every time we do this, can I get a goat, right? And what's a goat? It's the greatest of all time. And I'm going to go in here. Where's my goat? Yeah, my goat pictures. AI generated goat pictures because I paid off my mortgage in 2 years and 9 months, right? I am the goat. The goat. The goat. Okay. All right. So now let's go ahead and do this. And I am going to take a look here. Now we got to pay off these auto loans, student loan, and mortgage. And what is the easiest way to figure out how to pay them off and what's the balance left? I just put 29, 29, 29, 29, right? So I'm going to do that. And if you take a look here, even though we have the highest interest rate here, I'm actually going to pay off the 3 and 4% loans, right? And why would I do that is because I'm thinking of purely in terms of cash flow. And so if I pay off these 2 loans, move into line of credit, I'll actually get more cash flow here than paying off this 28 grand in the student loan. So let's go ahead and do that. And I am going to do this. So this is G2 plus G3. So it's 23 grand, right? And how am I doing this? Simply because I just don't save money. See how easy it is when you don't save money and you have a line of credit? So I'm going to go ahead and do that and then do this right here. And then plus 23150.19. And then, okay, this is going to be 0, 0. And look at this. Our cash flow has increased to 2750.41. Whoa! Wow. It got so big. That's what she said. She's talking about your cash flow. All right, so now let's go ahead and do this. So this is going to be 2750.41, and then I'm going to copy and paste. And then we see that in 38 months, this is all paid off, these 2 loans. Oh my goodness. All right, so now 38 months, so it's a little bit more than 3 years. So it's 51 plus 22 plus 21, so that's 94K, 94K. Let's do it. Let's do it. All right, and then now it's the student loan, so let's go ahead and pay that off in 38, 38, and then this is 0, 0, and I'm going to move this into the line of credit because it has a very similar interest rate. Even though it doesn't give me that much cash flow, it'll be fine. Um, Let me just kind of do this here, and I am going to go down here and then copy and paste. And then this is going to be plus 26425.53. And then guess what happens here? We get $400 of cash flow back. And now we got 3 grand of cash flow. So let's see how easily we can pay this off. And I'm going to do this right here. And then now we got to update that cash flow. So 3156.79. And then now it's going to do this, and I'm going to copy and paste this. And we see that in 46 months, it's pretty much been paid off. All right, so now I'm going to do that, and I'm going to do this 46 months, and it's 94 plus 35K. So it's $129,000 paid off in 46 months. Now, the last one is the mortgage, okay? So, if you don't know how a 30-year mortgage works, let me just show you something. If you go to the full term, 360, which is 30 months or 30 years, you pay 50% interest. I don't know if you knew that or not. So we need to pay it off quickly, but even though this cash flow index is high, just always be aware that's all a trade-off, right? High cash flow index means it's an efficient loan, meaning you have little payment compared to the amount that you borrowed. That's a good thing for sure in the short term, but in the long term, it's a no bueno. Take a look at this, $100,000. Okay, so we do have to pay it off, but what I'm saying is that we got to pay it off last. Okay, remember the cash flow index. Get as much cash flow as you can in your the overall. How much size is this? Overall holistic context of your financial profile. And then when you have the most cash flow, then you pay off the mortgage. And the easiest way to pay off the mortgage is using what we call the chunking method. Okay. So let me just show you something about the chunking method, which is kind of crazy. And a lot of people don't realize this. Okay. Let's say I had a 0% 30-year mortgage. So after 30 years, I'm not going to pay a cent over 200,000. Now, I know there are people out there who freak out because, at the end, if you have a 3% mortgage, right? At the end of 30 years, you're going to pay 50% interest. So even if you did this strategy with the 0% interest, yes, obviously you're going to overpay because you're using the 8% line to pay off a 0% loan. But no one's going to give you a 0% loan, or most people won't, unless you're doing something called seller financing. Okay. Now, when you get it from a traditional bank, it'll probably 6%. But I'm just saying, people freak out about like the interest rate difference. And yes, the interest rate matters, but it doesn't. Okay. So let me just kind of show you here. And I'm going to do this, right? So, um, what's my income? 6,000, expenses is 2,000, and we'll just do a $6,000 chunk, meaning you're just moving parts of the loan, $6,000 going down to zero and then rinse and repeating over and over again. And so what's the original balance? It's 200,000, 200,000, 0%, 200,000, and then the payment amount is 555.56, 555.56. And then people will freak out. Oh my goodness, this is the biggest mistake ever. I can't believe you would ever use a 8% line of credit, blah, 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 blah. And then the most that you can overpay is 1,400. Okay. Like 1,400 is, I wouldn't say the most, maybe you screw up, but I'm just saying if you did this strategy and you had no idea what was going on and you just kind of followed bad advice, and I'd never overpay like a 0% loan with the 8% line of credit unless I'm trying to like just get more credit from the bank because the bank likes it when you use their money, right? Um, I mean, even if you did use the 8% line of credit, what's the worst that can happen? Oh, okay, I pay by overpay by 1,400. Big deal. Now, let's say that you did this strategy with the 3% mortgage, 843.21. All right. So look at that interest rate difference, hey? Take a look at that. Now, what's the current balance? It's one, actually, we're at 46 months right now. So 46. So we're at 183,290.92. So I'm just going to put in 183,290.92. And blam, we saved potentially about 69 grand, right? So again, um, it's all about perspectives, right? So yeah, you could say like, hey, if this is a 0% loan, there would be absolutely nothing saved and all be just kind of like a waste. But we're literally paying off even a 3% mortgage in about 4.1 years. And look at all that, the money that we save, and look how easy it is too. Folks, I don't know if you know this or not, but easy has a lot of value. Like if something is made easy for you, and you could just do it and not think about it, which is why I love this velocity banking strategy. Why wouldn't you do it? I don't know. All right, well, that's it for today. So let's go ahead and wrap this up. 46 divided by 12 plus 4.1, and then that's 7.93 years. We are debt free, and then I'm going to do 0, and then this is going to be how much of debt? 329K paid off in hold on, 329K paid off in 7.93 years. Can we get a goat for that? Greatest of all time? Because that's what we are, the greatest of all time, right here. Paid off a mortgage in 2 years and 9 months, right? That's what we are. We're the greatest. And then I got a first lien home equity line of credit. So here's the thing. How do you achieve all this? Basically, don't save money, right? Like I was talking to someone who's a vendor of mine, and I told my vendor, I was like, listen, you already know this velocity banking strategy. And she's from another country. And she was like, I can't, well, I don't know if she said I can't do it, but she's like, in our country, saving money is very, very valued, right? Saving money is a good thing. But me, I'm like, bro, well, I didn't call her bro, but I was like, but I wanted to say, bro, what you talking about, Willis? What you talking about? Okay, I don't save any money because all of my money goes into that line of credit. See how easy it is? If you just think differently from the average American, and people are like looking at these spreadsheets, like, the average American doesn't make $6,000. That's not what I'm talking about. The average American can't even get a mortgage. I don't know if you knew this or not, but 90% of the people in this country don't qualify for a mortgage. Did you know that? So, what the difference between the average American and the velocity banker is what's your main operating account. For the average American, it's your line of credit. I'm sorry, it's your checking account. And then for your velocity banker, it's your line of credit, right? You dump all your money to line of credit, take your expenses out, and then rinse and repeat over and over again. And then 7.9 years, we're all debt free. Debt free, completely mortgage, auto loan, credit card, it's all good, and we didn't have to worry about it, all right? Look how easy that was. Look how we're the boss, right? Look how we're the GOAT. Look how we're smarter than the average bear, okay? All right, well, that's it, folks. So this is Korean Atlanta Mentorship. Have a good night, and I'll see you on the next video.